Good morning, everyone, and thank you for logging into this morning's presentation. I'm joined from Los Angeles by Eric Souders. Eric is the portfolio manager of the Payden Global Income Opportunities Fund, and we have a prepared presentation to run through with you. What we might do at the end of the presentation, though, is encourage your questions. We'll be taking questions from everyone during the at the end of the presentations. So please submit your questions for us to respond to. Eric, just by way of introduction, we set the fund up in Australia going back to 2013, and during that period of time, we were contemplating. We were already dealing with low absolute levels of interest rates, and shortly thereafter interest rates went negative in Europe and certainly in Japan. So we had this really unusual set of circumstances to deal with, and what we wanted to offer investors was an opportunity set as broad as possible in order to take advantage of getting a return in excess of incredibly low rates. I took a look at term deposits yesterday at 35 basis points in Australia for a 12-month term deposit with the Commonwealth Bank. And the problem we find ourselves now, particularly in the context of inflation, is that interest rates are significantly negative, in a real sense or an after inflation sense. So having a vehicle that can give you a decent return in excess of cash rates or benchmark rates really has become more important today than it ever has in the past. So by way of introduction, Eric Souders is the portfolio manager of the Payden Global Income Opportunities Fund. We've been partnered with Payden in Australia since 2011. This has been a very successful fund for us, both in a retail context and an institutional context. And this morning, what we thought we'd do is just go back to an introduction to the fund and its role in the portfolio. Then we'll talk about some themes impacting fixed income markets today, and then fund positioning. And then, of course, after that, we'll have questions. So with that, I'll welcome Eric Souders.
Great, thank you, Damo. Good morning, everyone, and thank you all for joining this morning. I really appreciate the support and the attendance. And as Damo mentioned, please feel free to submit questions, and we'll take those at the end. Let's go to the next page and just cover the firm very briefly. So Payden Regal, we've been in business since 1983. So actually just had our 38th birthday. We are headquartered in Los Angeles, which is where I'm taking this call today. We do have offices around the globe in the UK, London. We've had a full trading operation there for the last 20 years, and we've also got an office in Milan on the European continent, and then another office in the States here in Boston, and of course our partnership with GSFM. Payden is a firm over 200 billion in assets in Aussie terms. We do manage assets really across the gamut of investor types, pension plans, insurance companies, corporations, etc. And then also across both unconstrained portfolios such as this fund today, in addition to dedicated mandates really across the various asset classes: corporate credit, developed and emerging markets, government debt, and then of course securitized product. This specific strategy manages roughly 20 billion in Aussie dollar terms. And again, the strategy has been around for about 13 years, actually approaching our 13th anniversary from a strategy standpoint. And then as Damo mentioned, I've been partnered with GSFM for going on a decade. Payden is independent, so 100% employee owned, which we think is wonderful. It just helps us control our own destiny. Not much bureaucracy with respect to getting things done, moving initiatives forward, so we can really control outcomes with respect to things like technology, and then just new business opportunities such as this fund a decade ago. I'll go ahead and move to the next page, please, Zane. So ESG is obviously a very important topic, and for us, we've been we believe we've been involved in ESG really going back decades, with clients that have various sensitivities, really more exclusionary in nature, entities like churches and specific corporations that have very deliberate interests with respect to sensitive areas. But more recently, we have become, more officially engaged in ESG with respect to our commitment around things like climate reporting. So we are a signatory to the UNPRI, the Principles for Responsible Investing, and as part of that, we are part of a financial stability task force around climate-related disclosures. So, very, very committed from a firm standpoint. We've been a PRI signatory since 2013. And again, it's really been a part of the fabric of the firm going back decades. We don't have a lot with respect to ESG in the presentation today, but it is certainly something that is integrated directly into the fund. And so if you do have any questions about that, either on the call today or subsequent to the call, we're happy to pass along a bit more information. But definitely wanted to mention that ESG is integrated and is a part of both the fabric of the firm and then, of course, the fund. Let's go to the process. So we're going to talk a little bit about the process from a team standpoint, how the fund is set up, and then the role of the fund in the environment today, which Damo already gave a very nice sneak preview regarding. So the team is in the center of this. We call this our fried egg page. The center of the nucleus there. We do have 7 members of the team, myself obviously included. And then I think what's important to know is that we're surrounded by the various asset classes that really help support the strategy and the fund on a day-to-day basis. And as I had already mentioned, many of these strategy teams around us, they're managing portfolios in their dedicated world. And I think what's important with respect to the way that we manage the fund is the collaboration that we have with each of these sector teams. What we don't do is we don't give risk budget to the various groups. So we're not giving 10% of the fund to high yield. We're not giving 10% of the fund to emerging markets. Instead, we're working directly with them to make sure that the positions and the ideas that get incorporated in the fund can stand on their own 2 feet from an absolute return standpoint relative to what they might be doing in their benchmark focused world. So we tend to find that giving out risk budgets to the various asset classes, that tends to import benchmark focused ideas that may not necessarily be a fit for what we're trying to accomplish in this specific fund. So I think that really sets us apart from our competitors with respect to the approach. It's very, very collaborative, and we're not sleeving things out. Instead, we maintain all that ownership on our specific team. The process collectively from a team standpoint is driven by macro themes from the Investment Policy Committee. We have a couple of members on our team, Brian Matthews and Nigel Jenkins, in the top of that circle there are both standing members of the Investment Policy Committee. So they're really driving the themes with respect to interest rates, credit, more of the macro environment sort of drivers. And then our global economics team, they're going to help us set the stage in some of the more micro ways. So things like the consumer, things like housing, things like inflation, et cetera. And then, of course, the fund and the firm really more broadly is going to be governed by an independent risk management team, which we show on the bottom left part of the page here. So team of 7, intimately involved in the strategy, helping run the fund, supported by various professionals across the asset classes, really working in a very collaborative way. Let's go to the next page. So in terms of the process, I think that I think it's important to just underscore the simplicity of the process, collectively speaking. And we've really navigated through various environments going back, as I'd mentioned, 13 years. Whether that's the European debt crisis, a taper tantrum, the commodity crisis, then of course COVID. And I think what's important is the process has not changed. It's been tested, but it has not changed. It's been very durable through various time periods. And I think that the simplicity of the process, really is a testament to why it's, I think, held up in just a variety of different environments. So it starts with the base of the pyramid here. It is sized to scale with respect to the drivers of return. So we're really building a nice diversified portfolio that's drawing upon ideas across all the asset classes in all parts of the market globally. Australia, of course, the US, Europe, and then the UK, in addition to Asia. So really unlocking opportunities across the broad opportunity set with respect to sector and, of course, currency. We're focused on the front end of the yield curve, and I think that's important. As Damien mentioned, just regarding the current interest rate environment. Obviously, inflation is becoming more of a concern. We are focused on the front end of the yield curve, which tends to be more durable during bouts of volatility. I think that the most important component of that might be the fact that the issuer is really the one that's going to be repurchasing that security back at par when it matures. And so if you've got to focus on the front end of the yield curve, that security can really march toward par as it really approaches maturity, which is a much different dynamic when compared to securities that are maturing in 10 or 30 years. So very focused on the front of the yield curve, really relying on our good credit work and the credit research that we do across all the asset classes to drive the outcomes. And that's going to be that core income part of the portfolio. That's going to be complemented by some tactical trading. So the tactical trading bit is going to be, taking views across various parts of the market, whether that's interest rates, currencies, or spread product. And these are going to be positions that don't fit naturally into that core income part of the portfolio. They're either going to have a longer duration profile, or they're not going to have a final maturity. Things like interest rate risk or FX positions don't necessarily have a final maturity. I think what's important regarding tactical trading is it's very disciplined with respect to risk management. So all positions are attached to a 5 basis point stop loss provision. So if any position is out of the money by 5 basis points at a fund level, it's immediately closed, and we move on and potentially revisit that position in the future. But I think that our discipline around cutting our losses is very important. And we're also really looking for positions that have attractive asymmetric profiles. So something better than a 1-to-1 payoff. So we're really not flipping coins here. We're trying to extract views and value in positions that we think have a better than a 50-50 chance of really making money for the fund. The final piece of the pyramid and the process is going to be hedges. You could really exchange that for insurance. What we're doing here is incorporating some protection around the core income part of the portfolio. So spending a basis point or two each month, typically in vehicles like out of the money options on either equities or credit instruments to protect the credit risk that we have embedded in that core income part of the portfolio. The hedges are designed really to smooth returns over time and just help preserve capital during periods of volatility. And we've seen that work out pretty well going back 10 years. So that's the construct. Pretty simple, repeatable, and I think pretty easy to understand. A core income part that's going to drive the bulk of returns, a little bit of tactical trading, and then some insurance on top. Let's go to the next page, please. Okay, so the role of the fund in the current environment, I think that a lot of the text and a lot of the elements here are going to be crystallized when we talk a little bit more about the actual fund positioning at the end of the presentation. But some of the key features today: interest rate risk is low, which Damo and I have both already talked about. We've got about half of the fund exposure in floating rate instruments, and about 70% of the securities in the exposure have a duration of less than 3. So again, very much focused on the front end of the yield curve, and very little sensitivity to overall interest rate duration, which has really helped the fund from a performance standpoint this year, certainly relative to some of the traditional parts of the fixed income market that have had some difficulty as rates have risen and yield curves have steepened, especially here in the U.S. Credit risk, the fund it's very well diversified, across really all of the asset classes. We're finding less value today in some areas like investment grade corporates. We think there's more value in some of the more niche areas like emerging market debt and mortgage credit, both residential and commercial mortgage credit. And we think that some of these elements that I've just discussed really help with any sort of inflation surprise that we may have in store for us in the next 3, 6, 12 months, which is again half of the fund exposure to floating rate securities. And then also about a third of the fund is going to be in mortgage credit instruments, which tend to benefit from modestly higher inflation. Liquidity is of course important. Liquidity becomes, I think more important, obviously during periods of volatility. And so when credit spreads are tight, we want to make sure that we're not complacent. And so we're always incorporating some degree of liquidity in the fund. And the tighter the credit spreads are, the more optionality we view liquidity to have. And so we have built up a bit more liquidity in the fund today when compared to prior periods. Let's go to the next page. I'm going to wait for these key themes at the bottom. I'll talk about that on the subsequent slides. So some of the key themes today, I've mentioned residential mortgage credit. It's really been, I guess, nothing short of breathtaking in terms of the performance of the housing market, specifically here in the U.S. It's really been incredible to see housing prices up 20% year over year throughout a pandemic. It's just it's nothing short of remarkable. And I think that these three charts here in the bottom left and then the right hand side, I think they really support our narrative around mortgage credit. The bottom left is showing two things. One is showing the blue line is going to be mortgage debt versus overall GDP, and what you can see very clearly is a significant delevering with respect to mortgage debt when compared to 2008. So the overall market from a leverage standpoint is just in a much healthier position today, when compared to 10 to 15 years ago, almost a 20% reduction in terms of the overall leverage. And then the orange line is showing the increase in home prices in real terms. So this is going to be inflation adjusted. We do think that the recent increase in prices does give us a little bit of pause, but nevertheless, it's been a very persistent march higher in prices. And what this has created is a lot of equity built up in the underlying homes and the collateral for these mortgage instruments. So a very nice combination of lower leverage at the collateral level with increased prices and increased equity cushions. And you can see that on the top right chart, which is showing the weighted average loan to value across the U.S. housing market. And it just turns out that the most recent vintage in 2021 has the lowest LTV going back nearly 20 years. And you can see consistently subsequent to 2007, loan to values have been far lower than they were in the years leading up to the GFC. The bottom right part of this page, just to hit on this real quick, supply and demand. It's no secret, I don't think, that the U.S. housing market is undersupplied, and that's really been a function of the discipline that we've seen from home builders again after 2008. There was a lot of turbulence. Many people were snake bitten, and we've seen a lot of prudence and discipline around sort of the resurgence of home building. And you can see the blue line there is showing permits still well below levels of 2005 and 6, and then new home sales as sort of a corresponding knock-on effect there are also well below 2005 and 6. So this is all to say the U.S. housing market today is very different than it was 10 to 15 years ago, largely because it was the epicenter of the financial crisis back in 2008. Next page, please. So I won't cover all of this because it is quite a bit of information, but I think the bottom line here is when we look at the fund exposure in the top left, we do have about 15% of the fund, that's going to be the blue line there, in mortgage credit. And that's come down by about 1.5% so far over the last 3 or 4 months. It's pretty consistent with where it was at the beginning of the year. But if you take this chart back 2 or 3 years, we do have less exposure than we had at our peak in 2019. The red line is showing our credit risk in the fund with respect to overall mortgage credit. And that's come down materially. And the reason for that is because of the seasoned exposure that we have. The seasoned exposure is delevering. Prepayments have been quite high because interest rates still remain fairly low. And so what that's led to is a much more conservative credit profile around the securities that we hold in the fund, despite the overall percent remaining fairly consistent. And you can see in the top right box, what we're showing here is the percent of the fund across the various vintages. And so the bulk of the exposure, the bulk of that 15%, is going to be in securities that are at least 2 years seasoned. And you can see the average starting LTV there in that third column is much higher than the current LTV. I mean, just taking a couple examples, 2019, the starting LTV was 84, today it's 65. So again, the rise in housing prices has created a significant degree of cushion for homeowners, and that's been a major tailwind for mortgage credit. Let's go to the next page, please. So CMBS, commercial real estate, obviously, one of the most topical areas throughout COVID. Various parts of the market. You have various property types, which we show here. There's quite a bit going on this page, but I think what's important is we're displaying various property types across the x-axis there. So industrial, multifamily, retail, office, lodging, mixed use, and other. And what we're showing is what's happened to loans within each of these property types since June 2020. So really, sort of a 1-year look back period as this data is as of the end of April of this year. And what you can very clearly see is that specific property types like industrial and multifamily have had significant healing. So roughly 96% of the loans in the industrial space, for example, have either cured or completely paid off. And those are loans that were delinquent in 2020, June 2020. So really a tale of two stories here with respect to property types that are benefiting from COVID. So that would be industrial and multifamily, and those that have been much more impacted by COVID. Obviously, office and lodging on the hotel side have been much more impacted by COVID. So the fund exposure has been much more concentrated in the industrial and the multifamily complex, just given the value that we found there relative to some of the more volatile property types. So I think it's important when we talk about commercial real estate to really understand and differentiate between property types in terms of what's going on from a fundamental standpoint. Next page, please. Okay, and again, I think that similar to the residential mortgage slide, this just sort of highlights and underscores what we've been doing in CMBS. And the right-hand side of this page, the dark gray portion is showing the overall fund exposure to CMBS. So it has increased, over the last two or so years, from about 10% to about 16%. But what you can see is that the majority of that increase has come by way of industrial, which is the green line there. And then also multifamily has been pretty steady in terms of fund exposure. About a third of the fund is in multifamily, and about 25% of the fund is going to be industrial. So again, very, very focused on specific property types. And then in terms of value, the bottom left chart here is demonstrating the value that we're finding in commercial real estate relative to some of the more traditional areas like BB high yield corporates or BBB investment grade rated corporates. And what you can see is we're showing commercial real estate CLOs, and then we're showing SASB, which is really short for single asset, single borrower. So one specific property type. You can see a material spread advantage in BBB rated CRE CLO versus BB rated high yield, and then also a material spread advantage in investment grade rated single asset, single borrower versus investment grade corporates. So you're really getting a nice pickup from both a rating standpoint and an overall spread profile. And again, we feel very confident in the fundamentals of the specific asset classes within CMBS in which we're participating. Let's go to the next page, please. Emerging markets has been another big theme for the fund. And it's an area that we have become more constructive on over the last 6 to 12 months. We're really viewing the reopening of the world in three major phases. The first phase, we believe, is behind us. That was the Chinese and the US recovery really in the second half of 2020 and in the first half of 2021. We think we're in the second phase now, which is going to be the reopening of the rest of the developed world. So that would include Australia, the UK, and continental Europe, and of course, certain parts of Asia. We think the final pillar in terms of the recovery is going to be the emerging market world. And we're seeing some signs that we're very optimistic about, which is the rollout of global vaccinations. So you could see here on the left-hand part of this page, global vaccination doses are expected to exceed 11 billion by the end of this year. And Goldman Sachs is predicting that, roughly 75% of the globe will be vaccinated before the end of this year. That might be a little bit aggressive in terms of that prediction, but we think that we're going to get close and certainly get much closer, if not there, by the first half of 2022. And we're seeing the emerging markets world benefit from that. I think that China is supporting something like 75 to 80 specific countries in the emerging market world with respect to rolling out the vaccine. And that's really showing up in some of the data on the right-hand side here. So the blue line is going to be reflecting mobility, which is really tracking people's activity around public places, whether it's transportation, restaurants, et cetera. So you can see a very pronounced drop, obviously, throughout the beginning innings of COVID, if you will, and then a material increase, over the last 3 or 4 months, really getting close to pre-COVID levels. And then the the red colored chart or line rather is showing the number of cases in the emerging markets world. So a nice drop off there recently, and we think that that's going to continue to move lower. Let's go to the next page, please. So the value proposition is always a piece of the puzzle, and in the emerging markets world, the value today is about as good as it's been on a relative basis going back 10 years. And so what we're showing here is BB rated sovereign debt. So focused on the BB part of the capital stack, which is really where we're focused for the fund, and then also focusing on sovereign debt, which again is the profile which is most prevalent in the fund. And so that's going to be the blue line there, and the orange line is going to be BB rated high yield corporates. So the gray line is going to be the difference between the two on the right hand axis, and what you can very clearly see is that relationship is at a 10-year wide. So why is that? Well, it's I think a couple of reasons. One, the corporate credit market benefited last year directly from activity and behavior from central banks. Obviously, the Federal Reserve was directly buying investment grade and high yield corporates, and so that market recovered much quicker. And fundamentals have been improving much faster in that part of the market. The second reason is, I think, just the laggard effect in the emerging market world with respect to vaccinations. And there are roughly 80 countries in the EM world, so it's very, very idiosyncratic. And for us in the fund, we own about 20 to 25 countries today, so we're being very, very selective where we have our specific exposure. So again, this relationship from a value standpoint is at a 10-year wide. And when we think about starting levels, I think what's interesting to point out is that emerging market spreads today, so that blue line, they're roughly at the same level that they were at the worst point of the taper tantrum. So you can see in the very left part of the chart, in the middle of 2013, the blue line moved up, about 100 basis points, maybe a little bit more than 100 basis points. That was the worst part of the taper tantrum. The blue line today is about at the same level. So I think that gives us a little bit of comfort around our starting spread today relative to a period like the taper tantrum when interest rates did move materially higher. So we do like EM. We think it's going to be a story that's going to take, a couple of quarters to play out, but we have been adding exposure in the fund in the BB rated sovereign part of the market. Okay, I'm going to try and tie it all down here with the way the fund is positioned today, and then we'll open it up for questions. So, Damo mentioned at the beginning of the call, cash rates are quite low. So, the fund today is kicking off, a pretty good yield of 2.3% yield to maturity there, the third row down. The number of issuers is 250. I think that's an important number for us, because when we think about the 7 or 8 asset classes in which we're participating, it's about 30 or 40 positions in each of them. And so it's a very manageable number of positions that can really help us get our arms around what we're doing. And that was actually quite helpful throughout the COVID experience. We were able to really re-underwrite all those positions multiple times. So I think this number really ties into process, and it ties into repeatability, and it's very important for us. The rating of the fund, investment grade rated, low BBB, interest rate duration is quite low. So we brought that down We really brought that down over the last 6 to 12 months. We came into the year with the duration a little bit north of 2, kind of in the fourth quarter of last year. We brought that down to 1 coming into January of this year, which has really helped insulate the fund from a performance standpoint so far year to date. A credit spread duration, that's where we're really going to be generating most of the returns. That's going to drive performance. That's around 3.5. That's usually between 3 and 4. The bottom left portion is really just showing the distribution of the various sectors in which we participate. You can see a very nice mix. And we really separate the fund between securities that we call opportunistic and those that we call more stable. We are pretty constructive on the broad backdrop from a fundamental standpoint today. So the fund is tilted toward opportunistic securities. But we do expect this to come down a bit over the next 2 or 3 weeks as we're looking to take some profits in certain areas like high yield, for example. So a very nice mix from a diversification standpoint across the asset classes. And again, skewed a little bit toward being more constructive on the opportunistic side there. The bottom right, just to tie the bow on the duration narrative, about half of the assets, again, are in floaters, which you can see here. And about 65 or so percent are in securities with a duration of less than 3. And about 85% less than 5. So again, very, very focused on the front end of the yield curve, which we think does a nice job at insulating price volatility. The next slide just shows the evolution of exposure. I won't talk too much about this except to point out that we do dial up and down the risk with respect to opportunity versus stability. We do shift things around. To a pretty good degree. It's not a buy and hold fund, but I think that we are very mindful of risk management. So you're never going to see that green line really breach that 75% threshold, going back 8 or so years. So risk management is very important. And then the box on the left-hand side is really just providing a little bit more granularity around what we're doing in the various asset classes. So you can see, again, good rotation from a beta standpoint, and then also nice subsector movement going back 2 or 3 years. And finally, we show performance on the last page. It has been a good year so far, year to date. I think the fund is up something like 2% on a net basis, which we don't show here on this page. But again, I think that's a very good result, both outright and versus some of the more traditional asset classes like investment grade corporates or certainly government bonds. So I'm going to go ahead and take a pause there and see if there are any questions and just open it up broadly. Thank you. Thank you
very much, Eric. Zane, I wonder if you could skip back to that that slide. Fortunately, we've had several questions submitted, Eric, which is great. One of the questions relates to the importance of an absolute return style portfolio. What do you see the importance or the relevance of this type of portfolio given the COVID environment and this prospect of higher inflation?
Yeah, well, I think that, for us, well, as you pointed out at the very beginning, I mean, being able to unlock opportunities in any part of the market and really be agnostic with respect to your sort of traditional benchmark characteristics, whether that's duration or asset class mix. We're not attached to any sort of outcome that you would be attached to if you're managing versus a benchmark. So we don't necessarily need to own anything. And I think that for us, that's a fantastic starting point, particularly when we think that rates are likely to rise and inflation could become an issue. So for us, we're able to build, what we believe to be a very diversified portfolio across really all the asset classes on a global basis, and really insulate ourselves from that duration outcome that you would be much more attached to with more traditional benchmarks. I think that the reality is, investors have, I think, come to the right conclusion over the last 5 or 10 years that a lot of benchmarks are just simply flawed, and you really don't need to own certain parts of the universe simply because that's part of a benchmark. And so I think for us, it's a fantastic starting point, being agnostic and being able to put something together that throws off, yields that are superior to some of our sort of benchmark closest comparisons and also keep interest rate duration today very, very low.
An interesting question here. With respect to a weakening economy and demand in China, what impact do you think that will have on US and European corporates?
Well, it should have a positive impact. I mean, China is a huge harbinger for global growth, and it's only becoming bigger each year. I think that the recovery that we saw in China in the middle to the back half of last year, I think was important from a stability standpoint with respect to the globe. I mean, I think the U.S. recovery was much faster than we would have expected in the back half of last year, and then the beginning of this year. That was obviously on the heels of good news from a vaccination standpoint. But China is very important for global trade, very important for global consumption, and I think that very important for our emerging markets narrative in the fund. China ultimately is the biggest piece of the puzzle for the emerging market world, and so that's a real big part of our thesis there. And again, we think that that's only going to become more important in the years to come. I think that China. There's always some transparency risk there, no doubt. So we're very selective with respect to direct investments in China. In fact, the fund today has no direct investments in China, and that's been the case for really multiple months, if not quarters. But again, I think that it's a very important harbinger for global growth and certainly for our emerging markets exposure.
Interesting. This is also an interesting question. With the all the attention globally on climate change, have you looked at green bonds, and do you see any opportunity for those in the portfolio?
Yeah, we own some in the portfolio. Yeah, we do.
Oh.
The green bond market has been it's really been growing tremendously over the last really the last, I'd say, 1 to 2 years. Last year was shockingly busy in the corporate credit market from a primary issuance standpoint. It was a record-breaking year during a global economic shutdown. So, and a lot of that supply came by way of green bonds. And so I think that what's important for us from a green bond standpoint is to understand the motivation of the issuer, and to be able to really track that motivation and those outcomes going forward. So we want to make sure that that there's legitimacy to whatever project or whatever outcome that green bond issuance those proceeds are going towards. So it's important for us to be able to check that box. And we have about 2% of the fund in green bonds today, and I would expect it as a base case that number to go up over the next 6 to 12 months.
Okay, we've got some. I've got a question around the securitized part of the portfolio and the securitized market generally. And I know you spoke about securitized in your prepared comments, but given the unexpected shocks to that sector last year, how is the sector behaving these days from a liquidity standpoint?
Yeah, so I think what's important, maybe just to take a step back, I think what's important regarding the securitized market is, again, the position that it's in today versus where it was before 2008. Documentation is much more consistent, much more transparent. That was a very big problem in 2007, 2008. Data availability is incredibly superior today versus where it was 15 years ago, arguably better in parts of the securitized market than corporate credit. In fact, Fannie Mae and Freddie Mac, two of the government-sponsored entities here in the States, they're now providing loan-level information on their websites across all the deals that they're involved in. So we can really get very good granularity around the securitized market. So I think data availability is huge. Investors 15 years ago were burned by lack of transparency, poor documentation, and that just really led to adverse outcomes. So the market and the investors, I think, are just demanding and have demanded for quite some time now improvements around both of those pillars. And that's really manifested itself in outcomes from a fundamental standpoint. So we've seen extremely low losses really across the board, whether that's the ABS market, the CLO market. Losses are pretty much remote in CLO, especially up the capital stack. And then, of course, residential and commercial mortgage credit, broadly speaking. So I don't want to say the proof is in the pudding, but I think that it's just important to consider where the market is today versus where it was 15 years ago. The investor base has also grown tremendously. That's helped from a liquidity standpoint. So I think that liquidity in the securitized market, it can be a bit tricky. And the reason that I say that is, during the COVID timeframe, for example, in a very counterintuitive way, investors were trying to just sell what they could sell. And so you saw some of the higher quality assets in the securitized market. Those were the most beaten up from a price standpoint. So areas like AAA CLOs, areas like AAA ABS, where again, principal loss from a credit standpoint is effectively zero. No single A CLO has ever taken a loss throughout its history. That includes the global financial crisis. So, when we saw the drawdowns that occurred in COVID, it was really important for us to separate liquidity from credit. And when we saw investors selling AAA rated CLOs at dollar prices that were 10 or 15 points below where they were before COVID, that to us was very much a liquidity decision and not a credit decision. So, we want to have, I think we want to get paid for liquidity. We believe that we do get paid for that liquidity in securitized. We want to make sure that we understand the investor base in which we're in the asset classes in which we're participating. So I think we're doing a good job at tracking that information. But we always, as I'd mentioned, we always maintain liquidity in the fund, and we were tested last year, and we were able to move the exposure around, make some, I think, good decisions in hindsight now with respect to some of the areas that were distressed. And then also provide investors liquidity when they needed it. So I think that it's important to think about the broad mosaic of liquidity. Securitized is part of it. We think we're getting paid for that liquidity, and we've also got nice liquidity in the fund away from securitized. A bit of a long answer, but I felt it was important to kind of put it in context.
No, that's
apologies.
Okay.
Sorry.
Maybe the person who asked that question will regret the length of that answer. But anyway, but coming back to taper. So about 8 years ago now, that was the taper tantrum, as it was referred to at the time, was a reasonable shock to fixed income markets around the world. Where do you see now tapering's back on the agenda? What are your thoughts there?
Yeah, I think what you have now is, I think you have a Federal Reserve that I think that they've been snake bitten a couple of times. They were snake bitten in the taper tantrum. They were snake bitten at the end of 2018, when I think that clearly in hindsight now, they just raised rates too fast. They were very, very programmatic about it, and the market said no, thank you. So I think that the Fed is going to be very thoughtful around the way they communicate. And the way that they taper. So far, they've really only telegraphed a very modest tapering. So we're talking 5 to 10 billion a month in terms of the reduction with respect to securities that they're buying in the open market, and they're buying roughly 70 to 80 billion a month. So for now, it's a very small reduction. I think that they're going to see how that goes. The market will always push them into certain positions, and the market will test the Fed. So I would expect them to be tested at some point. But for now, I think that the market has shown the broad investor community that they're not worried yet about taper. I think what the market is probably becoming a little bit more worried about is inflation. And so to the extent that the Fed allows that to run a little bit warmer than the market is comfortable with, that could create some adverse outcomes. So we're being very mindful of some of the real-time data around inflation. We're looking at things, like goods versus services inflation. We're looking at wage growth. We're making sure we understand the composition of inflation and the broad CPI basket. So I think to answer your question bluntly, Damo, or whoever asked it, we're not concerned about a repeat of the taper tantrum. We think that the Fed will do what they can to land the plane in a very, very orderly way, but they might land the plane a little bit too late, and so inflation could be an issue sooner than I think the investor community expects.
Regardless of that outcome, if there is some interest rate volatility, having so much of the portfolio invested in floating rate securities and equally in that 0 to 3 bracket of years to maturity really does give you a great scope to cushion the portfolio.
Absolutely, yeah. We think that a material pickup in inflation would lead to a steepening of the yield curve, and so we've got to your point, we've got very little exposure beyond 5 years. Half of the fund is in floaters, and then mortgage credit historically has shown, both residential and commercial mortgage credit has shown a very nice correlation with increases in inflation. So we think that those securities would benefit the fund. And we think that we're in a pretty good spot with respect to unexpected inflation.
Now, one last question, because I'm conscious of time. Any thoughts on Jerome Powell and the direction of the Fed leadership?
Yeah, it's tough to say for now. I think that Powell was the front runner. Probably before some of the recent unfortunate events around the personal trading activity of a couple of the Fed governors. So I think that that's caused a little bit of consternation just around the integrity of the Fed, and I think rightfully so. I think that the good news is that the market for now has not shown any sort of concern around that transition, around the uncertainty with respect to that transition. And if Powell is to be replaced, at least for now, the odds are that he'll be replaced by a woman named Lael Brainerd, and she's been on the Fed for quite some time. She's quite dovish, and so I think the market takes some comfort in the fact that if Powell is to be replaced, it's likely to be by someone that is quite dovish. And so I'm not concerned about that at this time, but I think we'll have more of an insight into that later this year.
We've actually had a late question, which is an adjunct to a topic earlier on. Coming back to green bonds, when did you start adding them to the portfolio?
I have to come back on that with a specific date. It's been at least a couple of years. So the green bond market has been around for multiple years, and we have participated going back at least 1 to 2 years. But we can come back, whoever asked that question, with a specific date and give some better context.
Okay. All right, Eric, thank you very much for giving us your time this morning, and to everyone who's dialed into the this morning's presentation. On behalf of GSFM and Payden and Regal, thank you very much. We do understand your time poor, and we appreciate that you gave up some of your time to attend this morning's presentation. So on that note, I'll say thank you, and hopefully stay safe, and we'll see you again soon.
Yeah, thank you all. Cheers.
Thank you.
Thank you.